Stocks have certainly enjoyed an epic run-up in their share prices. I'm Jill Malandrino, global markets reporter for the Nasdaq. Joining me today is Kinahan, chief market strategist for TD Ameritrade. Options is your wheelhouse, and we want to hear what the options market is signaling about this rally and if you expect some volatility to come back into the market.
Well, as you know, Jill, and anybody who trades options knows, VIX has been at historical lows and just above it for quite a while. And people are like, why, with all the questions in the world right now, is volatility so low? So a couple of reasons. The first one being, it's working how it's supposed to. If you think about how volatility is supposed to work, as we go up, it comes out. As we go down, it expands. So we've done nothing really but go up since the election. So with that, volatility is kind of working like it should. Now the interesting part, and this is a little bit of a subtlety in VIX, so for newer people, I understand if it seems hard, but it's a very simple concept. People don't necessarily want to pay for downside protection for buying puts. So what they'll do, and what you're starting to see a little bit more of in the SPX, which is what the VIX is drawn off of, is they're selling upside calls to buy downside puts. So it's not like they're buying protection, they're financing it by doing it other ways. And you see that in a lot of the stocks traded at the Nasdaq also. People doing that in things like Apple as it reaches all-time high, et cetera. So it's just the great thing about options is you can use them in whatever way you want to do. And so a lot of the individual stock names traded here at the Nasdaq, as well as the major indices, we're seeing that.
So what are some basic strategies you can use if you want to get long this market at this point? Because there has been such a significant run-up. A lot of retail investors aren't sure if they should wait for a pullback. Sure. There are some ways that you can use options, whether to derive income or hedge existing long positions to participate in this rally.
Absolutely. And so, you know, one of the ways that I like to do it, and I think that makes sense for a lot of people, is you can sell out of the money puts. What you do, so many of the people watching your show are so good when they use their charts. So use your charts and say, here's a level of support. Maybe it's 5 or 7 or 10% below where the stock's trading right now. You can sell a put down there. If we don't go down that far on expiration day, you keep the premium from your put. Now the risk is you have to be comfortable that you could be put the stock there, and if you are comfortable, that's a great way to do it. Another way is by buying vertical spreads. That is, you buy a call that's in the money, you sell a call that's out of the money against it. You define your risk up front, say here's what I can lose. The one lesson I would say for anybody who's new at options is please define your risk. Most really successful options traders know worst case scenario going in. New traders often tend to say, look what I can make. Experienced traders say, here's what I can lose, and I'm comfortable that if worst case scenario happens, I'll be okay.
Okay. Well, thank you very much for joining us at the
Pleasure,
Nasdaq.
Jill. Thank you.
And thank you for joining us. I'm Jill Malandrino, global markets reporter for the Nasdaq.